American homes are expected to be worth $1.7 trillion, that's right, trillion, less in 2010 than they were in 2009. And get this, since the market peak in 2006, homes are worth a whopping $9 trillion less. Diana Olick has more on what this might mean for the housing sector. Hello, Diana.
Larry, tally up the losses, and despite what we thought would be a bounce at the beginning of the year thanks to the home buyer tax credit, we will have lost a collective $1.7 trillion in home equity by the end of 2010. That according to Zillow.com, and that is up from $1 trillion last year. Take a look at another home price report out today showing a 5.8% drop in home prices at the end of November in a running quarter-to-quarter comparison from Clear Capital. The biggest hurt in the Midwest, not where you'd normally expect, but it is nationwide.
Until the foreclosures are let out, until we have the full inventory, until the free market takes over and allows people to buy homes for what they're worth, and people start believing in the economy, you got at least 4 or 5 years before we're going to be back to normal.
Mortgage rates aren't helping any. Last night hitting 4.91% on the 30-year fixed on bank rates overnight. That will price more potential buyers out of the market. Now, investors want to get in and rent to make a good profit, but they argue credit is too tight. But Fannie Mae's chief economist said today the mortgage giant and the administration are both looking at ways to fix that.
Well, we're certainly exploring opportunities to expand that, but the data in our own portfolio show that when you get to a certain number, like 10 is the number that we've chosen, if there's any default issue, all of the loans go bad at the same time.
Of course, any program would have to involve investor skin in the game and very strict underwriting. There's an awful lot of cash on the sidelines, especially in hedge funds waiting to get into real estate, and likely the administration knows that. Larry?
All right, thanks, Diana. We appreciate the update. So, has the housing sector hit rock bottom? Might it now be the best time to buy? Let's talk and debate. We have Brett Arends, Wall Street Journal, and Matt Englett, managing partner of KEL Attorneys, one of the top foreclosure attorneys in the U.S., defending over 10,000 clients. My Lord, Matt. I want to go to my pal Brett Arends first, though. Hey, Brett, whatever happened to the idea of buying low and selling high?
Well, that's exactly right. One of the things that really makes me feel this is a great time to buy a home is that I'm pretty confident no matter how much I say this, no one is going to pay any attention to it. People don't want to hear anything bullish about housing. They are not interested in housing. It is the one asset class where capitulation is all around. No one is interested. Everyone's like, no, that's over. I don't want to hear about it. And that is what you always get at or near the bottom of the market. Now, you won't catch the bottom of the market. There's no point trying to catch the bottom of the bear market. But house prices in a lot of places have come down so far that I got to say, you look at some of these valuations, look at some of the prices you can get in places that you might actually want to own a home, and they look like a really good deal.
I mean, Matt, the number that's being used is $9 trillion. Maybe the more important number is that prices nationwide are off about 35%. In some major areas, as you know as well as I or better, Florida, California, Las Vegas, and so forth, those prices are off 50, 60, 70%. So why isn't it a good time to buy, assuming you have the resources to do it and can meet the down payment?
Look, it's not a horrible time to buy, Larry, but it's not the best by any means. Here's why. We have not seen all of the distressed properties go through the foreclosure system and actually come onto the market yet. We have not felt that yet. Let me give you, for instance, I pulled a report the other day for the first week of December for everyone in Florida who is now 60 days late on their mortgage. This is for 1 week time period. There's 15,000 of them in Florida alone. That gives you an idea of the amount of distressed properties there are out there that have not even come to foreclosure. Forget about the fact that they haven't even hit the real estate market to be put up for sale yet. So we have not felt it all yet. Until all these distressed properties are on the market is still in a decline. And that's why it's not the best time to buy right now. It's going to get even better.
You'll never time it. And I got to say, a lot of the distressed inventory in places like Western Florida, and I suspect in some of the outer, quote, suburbs of Las Vegas, will probably never hit the market because it's just going to be written off. I remember 2 years ago traveling around Western Florida looking at the wreckage of the market there, and there were, quotes, 200 units was actually a condo development in a swamp that was never actually turned into a golf course, and that had already basically returned to ruin. I mean, it's still sitting there. Some bank may have it on its books as inventory, but I can tell you it's not part of the market.
No, but that's it.
No, all right, go ahead, Matt. Matt. Sorry.
I was just going to say that you're pointing to very unique situations in the market. I'm not talking about Southwest Florida. I'm talking about the whole state of Florida and all the other hard-hit states throughout the country. We have a lot of people who are distressed right now, and we have a lot of other people who are becoming into that distressed. They're going to have that distress label soon enough.
Matt, I'm going to ask you the question. I can't wait to pop this question. You talk about distressed properties. You talk about foreclosure property. I get that, okay? Here's my question. Why wouldn't an intelligent investor/home buyer buy precisely those distressed and foreclosed properties you're talking about? The price discounts are enormous, and no one's smart enough to catch the bottom. In other words, you're saying all this product is coming on 50% down, Lord knows, 70% down. Isn't that precisely the moment to buy? And particularly, mortgage rates are historically low, and we've probably already seen the low in those rates. So that's another peg. Why not go there, too?
Well, I agree with you on that point. If you are going to buy now, all I am saying is that make sure you get a deal as far as today's prices go, because we're still in a declining market. The prices are going to continue to go down for the next couple of years.
All right, Brett.
So if you buy right. So I agree with you on that.
Brett, let me go to the mortgage question again, because I've heard a lot of complaining and gnashing of teeth. Okay, long-term interest rates are probably going up. I think they're going up because the economy is improving. And I think tax cuts will make them go up more because the economy is going to improve more. Now, I want to ask you, Brett, can higher mortgage rates actually be an incentive to go out and buy a home and get a mortgage? Get it in before they go to 5% or back to 6%, which would be more normal.
Yeah. It depends how high they go. I mean, from 4.4% to about 4.9%, which I think was the figures from the lows as of this afternoon. You know, that's obviously it's an increase, and it does squeeze some people, but not an enormous amount. If they go very high, it's going to be a signal of inflation. I don't think growth is going to put mortgage rates up to 8-9%. You know, if we get inflation, don't forget real estate has traditionally proven to be one of the better hedges against inflation. I'd probably rather own be buying distressed real estate in the right markets right now than overpriced bonds. But, you know, listen, if mortgage rates go a lot higher, it's going to be signaling inflation. And then you've got another dynamic, and then basically real estate becomes a hedge.
Well, yeah, that's right. Real estate's a hedge against inflation. Yeah. That's another positive. I mean, Matt, I think my first co-op purchase in New York City in the late 1970s, I don't know, I think the paper I financed it with was about 12%. Yeah. People are complaining about 4 3/4 or 5. I mean, come on, what are we talking about here?
Well, that is true. Rates are low, but I agree with Brett on that point also that a 9/10 of a point in an increase in rate is not all that much. I don't think that is forcing people to buy. The rates have been low for the last few years, so I don't think that's really getting people off the fence and getting them to buy. People think, rightly or wrongly, that rates are going to stay low for the next few years and that they can sit and wait and get to the bottom of the market before they go out and buy.
You never catch the bottom of the market.
That's right. Rates, home prices, stocks, you never catch the bottom. Try to have a longer-term view. Brett Arends, thank you. Matt Englett, thank you very much. Appreciate it.